And now I'm very pleased to introduce Thomas Piketty. A professor at the Paris School of Economics, Thomas's research, focusing largely on economic inequality, has led to numerous papers and a dozen books. Capital in the 21st Century analyzes a unique collection of data that will transform debate and set the agenda for the next generation of thought about wealth and inequality.
Yeah, I'm very glad to be here to talk about this book. So let me tell you a bit more and what I have tried to do in this book. So this is really a book about the history of income and wealth. And you know, the income and wealth is not only about money and about numbers. It is about the social groups, the social class that are behind the different possible levels of income and wealth. And I try in this book to put together a lot of historical evidence and to confront it with different types of evidence, including literary evidence on how these different structure of income and wealth are perceived at different times in different societies, in order to sort of tell the story of income and wealth and what we know about the distribution of income and wealth since the Industrial Revolution in over 20 countries. So primarily, you know, this book is concerned. To me, this is more a book of history than a book of economics. There's a little bit of economics in it as well, but you know, for the most part, you know, the reason it's so big, and I apologize, it's probably too long, and sorry about that, but it's because it includes really a lot of historical data on income and wealth. I should really stress that although the book is written only by one author, and I am solely responsible for all the mistakes that might be in the book, it is really based on a collective research program. So, you know, I first started working on the distribution of income and wealth in France, and I started about 15 years ago, and then together with Tony Atkinson for the United Kingdom, with Emmanuel Saez, who's at Berkeley for the US, with Facundo Alvaredo for Argentina, Abhijit Banerjee for India, and you know, over two dozen other scholars, we've been collecting income and wealth data for over 30 countries, and you know, there's no way I could have collected all the data myself. So this book is really based on this collective research program, and you know, this is based on what is the most extensive database, historical database on income and wealth distribution that you know, has been collected so far. So this is still too little data. You know, there's a lot that we don't know, and you know, I try in the book to give what I believe is a consistent interpretation of the facts that we observe. But you know, I do not pretend that we are in the social sciences. We cannot know for sure that you know, this is the mechanism through which such or such evolution occurs. And in particular, you know, there's a part 4 in the book about you know, conclusions for the future and policy conclusions. So let me be very clear about the fact that you know, you can disagree with everything that's in part 4 and still find some interest in part 1, 2, and 3 of the book. So you know, I am much better at analyzing the past than the future, and you know, part 1, 2, and 3 are mostly about the past trends and history, and then part 4 is about sort of regulating 21st century capitalism. And you know, this 100 page at the end, you know, I try to make the most reasonable conclusion that I can draw from the historical evidence, but ultimately the real objective of the book is to allow everyone to sort of write its own part 4 and sort of get a better understanding of the kind of evolution we're in, and you know, this issue of income and wealth do not belong only to economists, they belong to every one of us, and the objective of the book is to try to make this material accessible, and I hope the book is readable. At least I have tried to make it as readable as possible to give this material and make this material accessible. Now, there's still a little bit of economic theory in the book, because you know, some conceptual framework is useful to think about what we find, and maybe let me say a few words about you know, one of the most important conclusion of the book is that one powerful force that can push toward rising wealth inequality in the future, and which has already pushed toward rising inequality in the past few decades is the tendency in the long run for the rate of return to capital to exceed the growth rate of this economy. And so this inequality, which in the book I note R bigger than G, the rate of return bigger than the growth rate, sometimes people are surprised about that and find this paradoxical. So let me maybe start by saying that, during most of human history, it was obvious to everyone that R was bigger than G. So people would not say it this way, but in traditional agrarian society, growth was zero. Basically, the population was stagnating, the productivity growth was close to zero. So, of course, R was bigger than G simply because the growth rate was zero, and the rate of return to capital, it will, as usual, vary across assets. If you have more risky assets, you can have higher returns. But if you take the return to land, which is the most important asset in traditional societies, the return will typically be 4 to 5%. In other words, the value of a land will typically be 20 to 25 years of annual rent to the land. And you can see, this was so stable in traditional agrarian societies that, for instance, you take any novel talking about landowners, take any novel by Jane Austen, it will be obvious that if you want an annual income of 1,000 pounds, you have to have a capital of 20,000 pounds, because 5% of 20,000 pounds is going to give you 1,000 pounds. It is so obvious that, Jane Austen doesn't even need to talk about percentage and rate of return, because everybody knows sort of deep in their heart, because this has consequences, for your own life, your marital strategies, what the kind of people you live with, you talk to, and this is so important that, everybody knew what the rate of return was, and that it was 4, 5, and not 2, 3, or 6, or 7. These numbers were important. And so for during most of human history, the rate of return was, say, of the order of 5%, and growth rate was 0%. So obviously R was bigger than G, and in many ways this was the foundation of society, because this is what allowed a small group of owners, landowners, or owners of whatever other asset there is to own, to live off their property and, to devote their life to something else than their own survival, and, they would care about, science or literature, or, they would go to the ballroom or do war or government, or, whatever you could do. But this is really what allowed a group in society not to just work for living, and that was certainly very important. Now, the Industrial Revolution, of course, has changed somewhat this equilibrium, but much less so than we sometimes imagine, in the sense that, in the 19th century, you have industrial growth and, a lot of innovation, but still, the growth rate is not higher than 1%, 1.5% per year. And so this is still much lower than the rate of return to capital, say 5%, especially because the rate of return to capital itself rose somewhat, probably to 6% with the new industrial investment. So, but in any case, even if it has remained at 5%, the gap with the growth rate was still very large. And I think this is the central explanation why the wealth concentration remained very, very large until World War I in most European societies. And this is a very interesting experience, because it would be a mistake to believe that the very large inequality of pre-World War I European countries is ancient history. And, so some people seem to believe that there's nothing to learn from history, and that, this were, I read in some reviews that we should not worry too much about this historical example, because, these were all, agrarian, stagnant societies, but 1900 it's not a time where, land does not matter anymore in 1900. I mean, it's only in Downton Abbey that you have a lot of land, but, in the real life of Britain and France, 1900, 1910, land is less than 5% of national wealth. Most of wealth is, financial assets, stock market portfolio, real estate, business capital, foreign investment, the level of foreign investment and stock market capitalization. that you have in London or Paris at that time was bigger than in the US today relative to GDP. 1900 is a time where we invent the automobiles, the electricity, the radio, so this is less important than Facebook, of course, but still these are important innovations. And I think there's a lot to learn from this sort of first globalization that happened until World War I, and where there was at the same time a lot of innovation, a lot of growth. So you had a lot of entrepreneurs. This did not start entrepreneur did not start with Mark Zuckerberg. You have entrepreneur in the 19th century, but at the same time you have huge concentration of wealth because this process of industrial growth and innovation is not sufficient to counteract. I believe the fact that the rate of return to capital is higher than the growth rate, so that initial wealth inequalities tend to amplify and that doesn't mean that wealth, when R bigger than G, that doesn't mean that wealth inequality will go to infinity, because at some point, someone in the family is going to dilapidate the wealth, or is going to make a bad investment, or is going to have too many children, or too few children, or you always have shocks in the life of families that make. So you always have some mobility. Some people go down, some people go up, but the level of concentration of ownership to which you converge can be extremely large. Now, during the 20th century, what really made this change was not so much the industrial growth due to the Industrial Revolution, but really a number of very unusual events, some happy, some less happy. So certainly World War I and the Great Depression, World War II had a major impact to reduce R, to reduce the rate of return to private wealth with all the destruction, the inflation, taxation. Between 1914 and 1945, the rate of return was reduced to very low levels and negative for many assets and close to 0% on average. And growth rates themselves in the post-war period were unusually large, partly because of the post-war reconstruction. So they went to 4-5% in continental Europe or Japan, but largely because there was so much recovery to do after the war. But then, once the catch-up, in particular with U.S. productivity, was over, around 1980, rich countries' per capita growth and productivity growth has been of the order of 1.5% pretty much everywhere, and it's sort of comparable to pre-World War I trend. And the other unusual event and in a way more positive event that characterizes growth in the 20th century is the very large population growth, due to the baby boom generation, and more generally to the demographic transition involved a very large population growth rate in the 20th century, and this play an important role in my book. These demographic forces. Just to summarize very quickly, if you have one way to make inheritance not too important is to have a lot of children. In a society where everybody has 10 children, you should not count too much on inheritance. And the extreme case where the population declines and you have very few children, if a country is about to disappear and you have the last generation of Germans in 2070, and the last generation will receive everything that was accumulated by all the previous generations, so the relative importance of inheritance will be huge. And even without to go to such an extreme situation, right now, in Germany or in China or in Japan, the size of the generations that are born right now are typically 30% smaller than the generation of their parents, and that's a very unusual and in a way terrifying evolution. And certainly this mechanically makes the relative importance of wealth to income, wealth accumulated in the past to new income and new output, possibly even more important than at the time of Balzac or Jane Austen. This can make the relative importance of wealth even more important than in the 19th century, because if you have only one children per family, you inherit from both sides or from zero side if both parents are poor, and this makes the transmission of wealth much more important than we thought in the post-war period, where indeed there was not that much to inherit because a lot had been destroyed by the war in Europe, and also the very fast growth made new savings and new accumulation more important than wealth accumulated in the past. So, what about the future? It could be that by an incredible coincidence, the growth rate will increase so much as to balance the rate of return to capital. It could be that we are going to have so many children and we are going to make so many inventions that the growth rate will go up to 4 or 5% and will sort of equilibrate the rate of return. But it will really be an incredible coincidence because there's no. I guess the main message of the book is not so much to make prediction about the future, but to realize that there's no natural force that should make this happen. These two central notions in the book are determined largely by different forces, and they have just no reason to coincide. And more generally, the market forces and the private property system have lots of virtues. They allow to produce new wealth, new innovations, but they can lead to very extreme concentration of wealth. There's no sort of built-in equilibrium mechanism that keeps this under control, and things can really become very concentrated, much more, much faster than we sometimes believe. And I guess one of the conclusions of the book is that instead of just waiting for this incredible coincidence to happen, we should try to set up institutions that could, in case this does not happen, allow us to fix the problem. So there are different types of policy responses that can work. The ideal solution, in my view, but I might be wrong about this, but it's a progressive tax on net wealth. Many people say, this will never happen, don't even think about it. I am a bit skeptical about these very strong claims about what will or what will not happen, because, the past history of inequality and taxation is, shows that, sometimes things happen even if we don't expect them to happen. So 1 century ago, in 1900, 1910, many people, including in the US, would say that the progressive income tax will never happen, and indeed the US Constitution made it impossible for the federal government to create anything like a federal income tax. And there was an amendment to the Constitution, the income tax was created, and in the end, very quickly in the 1920s, the US actually invented sharply progressive taxation of income and inherited wealth at much higher rates of progressivity than in Europe, largely because at that time it can seem strange viewed from today's perspective, but the US perception was that we don't want to be as inegalitarian as Europe, and one way to prevent this from happening is to have steeply progressive taxation of income and wealth. Then, starting in the late 70s with, under the Reagan administration, things moved the other way. But, each country has its own sort of intimate history with inequality and redistribution. And, you have very large changes happen all the time. And, right now, concerns about rising inequality in the US are certainly higher than they were 10 years ago. And, I think instead of just saying, this cannot happen, I think it's better just to see, to discuss about what will be desirable per se, and to try to make progress about our analysis of, the past evolution. The main message of this book is that, these issues about inequality, have not started 10 years ago. They have been with us for centuries and centuries, and a book like this is certainly not going to put an end to this dispute. We will always fight about inequality, but at least, the basic objective is to allow people and readers, to know a little bit more what we are fighting about and what can be done about it. So, sorry if this presentation probably gave you a sort of view of the book that is a little bit more technical than what the book really is, and this R bigger than G story is only part of what's in the book, where I try to give justice to the complexity and multidimensionality of this history of income and wealth, which is always deeply political, social, cultural. It involves beliefs about what's fair and what's not fair, and there's no way one can understand income and wealth with a sort of purely economic approach and a purely economic history. These issues require to have a sort of global view of history that is both political and economic. And let me stop there and take questions. Okay. So the question is what kind of data I use in this book, and in particular regarding the income tax data, how I could access to this data. So there are two broad type of data that I use in the book. One that relates to income, and in particular the income tax, and one that relates to wealth, that is even more important than income, and I will say a few words about it in a minute. So regarding income tax data, in fact, a big part of the income tax data comes from the fact that pretty much in every country, shortly after the income tax was introduced, the tax administration in the US, in France, the UK, started to publish very detailed tabulations of income tax statistics. So they would, for a very large number of income brackets, they would publish, the number of taxpayers, the total amount of income, and all sorts of details about, their information about whatever you need to compute the tax. Okay, so for instance, in France, where people have been obsessed with the low number of children to fight with Germany, there was this special tax saying, if you're a married couple and you don't have kids after 3 years of marriage, you will have an extra tax. That was created in 1920, and starting after 1920, you also have the information on how many people after 3 years of marriage still don't have children. So the tax data is very rich because it includes whatever information the administration needs to compute the tax. And believe me, there's a lot of imagination in tax law. People. That's the good thing about tax law is that you have to make very precise your perceptions about fairness and justice and who should pay more and who should pay less. You cannot just make general statements. You have to be very specific, and sometimes people have a lot of imagination on how to define who's doing the right thing. Anyway, this data is available because this was just published in this tabulation, and then the way to use this data is to try to infer from this tabulated data the full statistical distribution of income. And there are statistical techniques because the shape, the mathematical shape of the distribution follows certain regularities. Typically, this follows power laws or Pareto laws. So there are techniques, to just infer the shape of the distribution from this tabulated data. Now, for the more recent period, starting in the 1960s, 1970s, we usually, in most countries, have access to the micro file with individual tax returns. Sometimes these are samples, sometimes these are exhaustive files. They are usually anonymized files. You take away the name. In some countries, it's more complicated than others. The usual reaction of the tax administration is to say that the data does not exist and will never be accessed. But in the end, we always find ways to access it. And we have more than 30 countries in the database now. The other data source, and just one word about this, is about wealth. So wealth data is in a way more important in this book than income data, and it comes from the registration of wealth either through the inheritance tax system, where the administration will produce the same kind of tabulation as for income, or sometimes we actually had to go to the archives with the individual inheritance files. So for instance, in France, so that's why France plays a big part in the book, is that the French Revolution certainly did not create a perfect society, but at least it created a very modern tax system for the registration of wealth. So you have individual estate tax records starting in France around 1800, which you don't have in other countries, and so we return to individual archives, in Paris and in other parts of the country, just to get the individual data. And now there are sort of big data collection of this kind, which were impossible to do 10 years or 20 years ago, which are doable. And certainly, this book would have been a lot harder to write 10 or 20 or 30 years ago, because when Kuznets in the 1950s was using the same income tax data, he was doing everything by hand, basically. And of course, this puts strong limits on the volume of data you can process. And also, very often the books of this period, until the 70s or 80s, using this economic historical material, it's as if, the authors have suffered so much in collecting their data that, when they write the book, they sometimes it looks like a big statistical appendix. It's as if they want the reader to suffer with them. So they want to. So. I hope you won't suffer by reading this book, but at least, the good thing about modern technology is that you can put all the statistical details online. So, all the Excel files and details about data construction and how much I have suffered is not in the book. It's online for those who want to see it. And so that I can focus on the book, on telling a story and telling looking at the historical interpretation of this. So, I guess my main advantage over previous author is that the technology allows to do that, which others could not do. Yeah, I'm not sure I have answer for that in my book, but prescription about high frequency trading and yeah.
Could you repeat the question? Sorry.
Or am I going to be able to summarize your questions? I'm not sure. Maybe are you sure it's not? You don't want to take the microphone to summarize your question? Okay, so let me summarize the first question. Do I have a prescription about what we should be doing regarding financial innovations like high frequency trading and the implications for the dynamics of capitalism and wealth concentration? And I see. I guess one of the message of the book is that financial deregulation, and I'm not sure this answers on really exactly your point, but financial deregulation certainly contributed to the rise of inequality, because of rising incomes in the financial sectors, and also certainly rising inequality in access to good returns. So, very large portfolios have access to very sophisticated financial products and get good return, whereas, middle class or lower class portfolio get, really bad returns currently. So, but on the other hand, so, a financial transaction tax or, any kind of proper regulation of the financial system, can be useful in order to bring down this sort of excessive financial innovation, if you wish. But at the same time, even if we were to solve this problem, even if we were to fix this problem, even with a perfectly functioning capital market in the economist sense, you will still have, this tendency for high inequality and concentration of wealth through this R bigger than G logic, which has nothing to do with the capital market imperfection. So, my book is really trying to make the point that, perfect competition and perfect markets, are probably better than imperfect markets, but they are not going to solve our problems per se. It's sort of deeper. The contradiction which I pinpoint is somehow deeper than that. And sorry if that does not answer perfectly your question. Certainly, unequal access to voice and to political influence is certainly an explanation. So, when you have a lot of wealth, you do not consume only food. You can consume political influence. You can consume politicians, academics. So that certainly increases your influence. Now, I don't have a pessimistic view. I think democratic institutions and mass mobilization can respond to this. I think in particular in this country, we tend to forget that this has already happened before, and there was a response of the political system. In the sense that progressive income taxation, progressive taxation of inherited wealth, was invented in this country more than any other. And it's actually quite striking. To see that this is really the country where in the interwar period and then in the post-war period you've had the most progressive income tax system and inheritance tax system, and this did not destroy American capitalism. If anything, the growth rates were higher than what they've been since 1980. So I think for too long there's been this view that this high tax rate at the very top end are a bad thing. We need to get away with them, and I think we really need to reopen this debate, in a sort of very quiet and historical manner as we can. And I'm not saying that we just need to do the same as before. I think we need to invent also new ways. For instance, the taxation of wealth, the taxation of property in this country, is viewed, existing property tax in this country and also in many European countries were instituted in the 19th century at a time where property was only mostly real estate and land property, and you didn't have much financial assets, financial liability, and I think it would be much better to have a progressive taxation of net wealth, including financial assets, including financial liability, rather than the kind of proportional taxation of real estate property that we currently have, and which imply, for instance, that someone whose property value has fallen below its mortgage level, who has negative net wealth, continues to pay as much property tax as the people who don't have a mortgage. So I think, especially if the relative importance of wealth in relation to income rises in the future, and in the US it will depend a lot on future population growth. Population growth in the US is the key force that has made the wealth coming from the past less important relative to new wealth as compared to Europe. Now, the US is a country where population was 3 million at the time of independence and is now 300. So, of course, the past does not exist in a way. Whereas in France, population was 30 million at the time of the revolution. It's 60 million today. So, it's more or less the same countries, most the same families, and sometimes the same buildings, and it keeps. So, but in a way, this is also what makes the French case, I think, more relevant, for the future of the planet than the US case, because it's quite unlikely that the world population will be multiplied by 100 in the future, and so on. Or even the multiplication by 3 that we've had in the US over the past century, from 1 million around 1910 to 300 million today. Are we going to go to 900 million 1 century from now? Maybe, maybe not. But whatever happens is going to be important for the relative importance of wealth, and that will also be important for how we need to tax the stock of wealth relatively to the flow of income and output. And I think these are issues that are with us for a very long time. Yeah, IG is better for everybody. Growth is a positive sum game. If you have higher growth, it can be better for wealth holders or workers. So, in principle, everybody should prefer higher growth. But, even if we do all the right policies to promote innovation, increase the number of children and everything we can, there are limits to what we can do with the growth rate. And then for a given growth rate, even if we've done everything we can to increase the growth rate, clean growth if possible, which is not always possible, but to the extent that we make the right invention and invent the right clean energy, we can perfectly have high growth rate forever. But even with the highest possible growth rate, that's probably not going to be 4 or 5% per year. So for a given growth rate, assume it's, we only make 1% per year. If the rate of return is 5%, what will it mean? It means that in equilibrium, on average, wealth holders will reinvest 1/5 of the return to wealth and will consume the other 4/5. Assuming there's no tax, no other. Of course, some families will consume more than that, and then they will go down in the distribution of wealth. Some will reinvest more than that, they will go up. So there will be some mobility, but the point is that the distribution of wealth will tend to go to a more concentrated distribution, the higher the gap between this R and G. But, indeed, some of it is consumed. The whole point of property is that you can live better than if you are not an owner. The whole point of property is that it delivers a return that can be partly consumed. And with a low growth rate relative to the rate of return, you only need to reinvest a small part of the return to keep up with growth and to keep the same relative position in society. That's the good thing of a high return and low growth when you start with wealth, and that's also the bad thing when you try to enter the game. So, there are, even with a low G, you always have people who sort of manage to enter the game. It's just that it's more difficult. So, for instance, it's more difficult today, if you want to with a low growth rate for wage income, if you want to accumulate wealth only with your labor income, that's possible, but this will have to be a really high labor income. And in many cases, wealth transmission from your family will play a more important role than for the post-war period. And in the post-war period, people who had wage growth in the 50s, 60s, 70s, the growth rate of their labor income was sufficient to enter wealth accumulation more easily without inheritance than for the generation born in the 1970s, which I care particularly about, and even more so for the generation born in the 80s, 1990s. So you have it is more difficult over time, and the relative importance of inheritance tends to rise. There was a second part in the question.
The distribution of capital through, say, all the quintiles of society.
Yes. So right now, the concentration of wealth in a country like the US or in Europe is less extreme than it used to be until World War I. But it's sort of moving in this direction. And the big reduction in wealth concentration that has occurred had a lot to do with World War I, the Great Depression, World War II, and the progressive tax policies that were implemented in the aftermath of these shocks. So the question is about the impact of American academia, about the responsibility. Yeah, I think we all have a responsibility. I not really belong to the American academia, but but I guess the European academia also has a responsibility. And I think academics have a special responsibility as producer of knowledge and producer of research. Let me say, there was a time where, even American economists worried a lot about inequality, and for instance, in the book I talk about Irving Fisher, who was this president of the American Economic Association in 1920, and he was not particularly left-wing, but, he was really, his big concern, when he gave this big lecture to the American Economic Association in 1919, and his big message was, my fellow American economists, the one issue we should be really concerned with regarding the state of the American economy is that wealth inequality is soon going to be as large as in Europe. And, that will be just unacceptable. That will be an undemocratic distribution of wealth. And, our country of pioneers and our industrial dynamism will never survive to such a plutocratic evolution. And then he proposed, some steeply progressive taxation of inheritance, and his proposal was, you tax 1/3 after one generation, 2/3 after two, and 3/3 after three. And so this was not implemented exactly this way, but indeed, in the 20s and 30s, you had extremely steep progressive taxation of inherited wealth that was introduced in this country. And I'm not saying this is just because of academics, but I think academic discourse has an impact on whether these things can happen or not, and academics have a responsibility in sort of contributing to define what is possible and what is not possible. I guess there was an attempt under President George Bush to just repeal the estate tax entirely in this country, which eventually did not happen. But some of the norms and some of the discourse that have been produced in order to make this change in one direction or the other, were directly influenced by academics. And it will be interesting if I'm not sure that today's American economics, or that the president of the American Economic Association will make the same speech as Irving Fisher in 1920. But maybe it will come at some point. We'll see. No, this is national income is GDP minus capital depreciation plus net foreign income. So, for instance, so you need to take away depreciation. Depreciation is the fact that you have to repair the roof before paying income and dividends. And if you pay dividends before repairing the roof, then your net wealth will go down, so it will be like negative income. The other addition is net foreign income, because if you own a big part of other countries, and if they are paying rent or profits to you, then your income can be bigger than your output. Now, at the world level, of course, this has to cancel out. So at the world level, national income is just the same thing as GDP minus capital depreciation. But for individual countries, national income can be bigger than net output, and for some other countries, it can be smaller. In a country like the US right now, national income is essentially the same thing as GDP minus capital depreciation, plus maybe 1% in net foreign factor income. But in some other countries, like in sub-Saharan Africa, you could have 20% of net output that will go abroad for the owners of the capital stock, so that the national income will be 20% smaller than output, and typically this foreign capital outflow will be much bigger than the foreign aid that will come in. So it's important to have in mind, and that's an important difference between national income and domestic output. Okay, so the question is about somehow the geographical scope of the study, and these issues about the center and the periphery and emerging countries, how much is enters the book. So I try as much as possible to take a global sort of world perspective on the distribution of income and wealth. Now, it is true that due to lack of historical data, I very often have to focus myself on the case of Britain, France, the US, Germany, Japan. But I try as much as possible to include emerging countries. This issue of net foreign asset and sort of countries that own other countries plays a big role in the book, both in the history, because that's a big part of the history of capitalism, is the fact that Britain and France own a big part of the rest of the world until World War I, and I try to measure this and to show how much this mattered, and to compare this to the similar kind of dynamics that we have today. So China is certainly accumulating important assets on the rest of the world, but Germany and Japan even more so. And sovereign funds, sovereign oil funds is also something that I study. And, Africa, on the other hand, is clearly accumulating, debts and liabilities, and is being owned by So I try to, this international dynamics of inequality, if you wish, I try to talk a lot about them. Although, probably I could have done more in this direction. But this definitely plays an important role in the book. Okay, so population growth is important, but this is not the only force that determines inequality. So having a lot of children and having a large population growth in India is not enough to reduce inequality per se, because, of course, if you have very unequal access to skills, very unequal access to education, then you can have huge inequality of, in jobs and wages and labor earnings. So maybe inheritance doesn't play such a big role in such a society, but you can have enormous inequality in terms of access to jobs, access to skills. So this is another form of inequality. So the relative importance of inheritance vis-à-vis labor income is not the only dimension of inequality. And to take the other extreme case, which is the Scandinavian countries, I guess it's very inclusive educational institutions that sort of help people to get the right skills and access to the right jobs is certainly a very powerful force for in the direction of equality. Still, these demographic forces, I think, if you take a country like China right now with negative population growth, the issue of property taxation and inheritance taxation is really becoming really big in China. So sometimes it's regulated through sort of case-by-case basis. Some very wealthy oligarchs, are just expropriated or put in jail when they do politics. But it's a much deeper issue, because it also has to do not only with the very top, but just with middle people, and how do you access property for people coming from the countryside, and very large importance of inherited wealth for the urban Chinese elite, large movement in real estate property. And this issue of property taxation and inheritance taxation is not only important for rich countries, and countries like China is becoming really important. So the question is about the relation about money and power. It's again, I want to be, more optimistic than simply saying again and again that money can buy political power, which of course is true. But I think, one lesson of history is that democratic institutions are sometimes able to respond. So we should not just be fatalistic and deterministic about this. And I think. The problem is that sometimes, the kind of historical knowledge or international comparisons that we could all make, on a rational basis, do not always fly in the political debate. So, for healthcare, I think there is a lot of evidence than European-style systems, are working, much better than the kind of health systems there is in the US, and there are some parts of the university system are working much better in the US than Europe. So I think there's so much to learn by making this comparison between countries, but which sometimes in the political debate are very difficult to make. But with a more and more educated population, in principle, and there's room for optimism. So I don't want to be just fatalistic about money and power.